Capital appreciating or income generating? This is the question to determine which assets you should buy in order to build long-term wealth. When it comes to building wealth, not all assets are created equal. Some assets grow in value over time. That's called capital appreciation, or increase in net worth. Others pay you steady cash flow while you hold them. Those are income-generating or cash flow assets. But which one is better? Should you chase growth or focus on cash flow? Today, we'll break down the difference between the two, the pros and cons of each, and how you can combine them to build lasting wealth. When it comes to investing your money with the aim to make more money, you will often look at different assets. The key is to see if the asset can produce either cash flow or capital growth. Some assets can produce both for you, and these are the ones you should focus on. Often, cash flow is necessary, so you are able to hold the asset so you can realize compound growth on that asset value. Capital appreciating assets are investments you buy and hold because you expect them to grow in value over time. For example, you buy a residential investment property for $400,000. You hold that property for 10 years and reassess its value. You find out the value is now $800,000. Within 10 years, your investment doubled in value. Valuable rare artwork, stocks or ETFs, and commodities like gold are other examples that are capital appreciating with time. To realize this growth, you often need to sell the asset or take out equity from lenders. When you sell an asset as a gain, you may be subject to capital gains tax, and forming strategies surrounding this is crucial to retain most of your money. The other common strategy is cashing out equity from the property. This is tax-free money. Consider increased loan amount and hence increased monthly repayments when you choose this option. Equity is best spent on purchasing more assets as possible in order to grow your wealth further. Income-generating assets are investments that put money into your pocket regularly and is the essence of your money working for you. They make you money without having to sell them. This can be high cash flow property or certain businesses, such as laundromats or vending machines, that is fairly passive in nature to make you money without you having to be present. The ultimate passive income you can achieve is via ETF investing into high dividend yield stocks. They often pay monthly or quarterly dividend and give you strong cash flow. In order to reach a certain amount of dividends paid to you, you need to have a massive holding in that stock. This is talking in the millions or billions total asset value. In summary and most simple terms, capital appreciating is growth in asset value, and income generating is cash flow. The appeal of capital appreciation. Capital appreciating assets can make you rich over time. Take real estate, for example. If you bought a property for $300,000 and 15 years later it's worth $600,000, you doubled your money just from holding it. Same with stocks like Apple, Amazon, or Tesla. Long-term appreciation can create massive wealth. The upside? You don't need constant management, and usually you can set and forget. The downside? You don't see money coming in monthly. You're relying on future growth and the ability to sell at the right time. Imagine you held 10 of these $300,000 properties. Assuming they all grow to minimum $600,000 over 10 to 15 years, that is a capital appreciating totaling $3 million across 10 properties. This is ultimate wealth building, the appeal of income-generating assets. Now, income-generating assets are powerful because they give you cash flow now. Imagine owning a rental property that pays you $2,000 a month after expenses, or a dividend stock portfolio that pays $1,000 every quarter. That's money in your account without having to sell the asset. You are taxed on this rental income, so effective tax planning is essential to get ahead and retain most of your hard-earned income. The benefit is stability and financial freedom. The drawback? Income-focused assets might not grow as quickly in value compared to capital-appreciating assets. For example, a rental property might pay you good rent but not double in value as fast as a hot tech stock. An example of capital appreciation is in stocks. Amazon didn't pay any meaningful dividends, so it was cash flow poor. but its capital appreciation skyrocketed from 2005 to 2025, 20 years later. If you put in $10,000 back in 2005 and held it for 20 years and sold today, you would be a multimillionaire. That is the power of compound growth. If you held it long enough, the chances of capital appreciation improves. As long as you have done your due diligence and formed strategies on companies you think will grow over time, then you can make real money. An example of income generating but also capital appreciation is buying high-quality real estate in an area that hasn't been through its growth cycle yet. Buying a property for $150,000 then held it for 10 years would have given great capital growth and cash flow that would provide you steady income. This cash flow is enough to fund your everyday necessities while it still grows in the background. Consider this. If you quit your job today, capital appreciation looks good, but you cannot live of it unless you sell or take equity out. But income-generating assets are what will fund your lifestyle and get by in life. So the question is, should you invest into capital appreciating or income-generating assets? The truth is, and short answer is, you need both. You need to increase your net worth but also achieve financial freedom and security. It also depends on your life stage, age, and circumstances in life. When you are young, you are more inclined to take risks because lost money is easier to recover. You generally lean towards high-growth assets because you have more time. As you get older or closer to financial freedom, then income-generating assets become more important because stability and cash flow become more important. Adopt a strategy of balance. This strategy enjoys the best of both worlds. Use capital appreciating assets first to grow your wealth quickly. As your wealth grows, gradually shift more of it into income-generating assets. Eventually, aim to live off the income from your assets without you having to sell them. This is how the wealthy play the game of achieving financial freedom. So here's the takeaway. Capital appreciation builds wealth on paper, but income generation gives you freedom in reality. The smartest investors learn how to use both to their advantage. So, what's your next step? Let me know in the comments. Don't forget to like this video, subscribe for more content like this, and share it with someone who's ready to level up their financial game.